Have you ever wondered how recent shifts in the financial world could impact your investments? Let's delve into the heart of the financial sector, where the tides of change are constantly in motion. Picture this. Deutsche Bank, one of Europe's leading financial institutions, has just unveiled its third quarter earnings for 2023. Revenues rose by a modest 3% year-on-year, despite the investment bank and asset management segments taking a hit. However, expenses also grew, outpacing revenues by 1%, and resulting in a return on tangible equity of 7.3%. Now here's where it gets interesting. Deutsche Bank has announced plans to distribute a whopping 8 billion euros to shareholders until 2026 and aims to achieve a 50% payout from 2025. Can you imagine the ripple effects of such a move on the broader financial landscape? Not to be outdone, Commerzbank, another German banking powerhouse, has updated its capital return policy, setting its sights on a target payout ratio of 70% in 2024 and an 11% return on tangible equity in 2027. A fierce competition is brewing, and it's set to shape the future of European banking. Meanwhile, the world braces for expected rate hikes. UK money markets have flipped the script, transitioning from a no-rate rise stance to betting on a cumulative 35 basis point moves in November and December. Even across the pond, some are placing bets on a September 2022 Fed rate hike, despite the central bank's insistence on no rate rises before 2023. These shifts in the financial world are causing investors to reevaluate their strategies. Could yours be among them? Did you know that the performance of some of the biggest banks in the world could have a significant impact on your financial future? Let's delve into the recent performances of major banking players. The third quarter of the year brought mixed results for the banking giants. JP Chase, Wells Fargo, Citigroup, and Morgan Stanley, some of the largest financial institutions in the United States, had been expected to report weaker profits due to a combination of a slowing economy and volatile markets. Analysts had predicted a drop of 24% in profit for JP Morgan, while Citigroup and Wells Fargo were forecasted to see declines of 32% and 17% respectively. Goldman Sachs and Morgan Stanley were not left out of this wave of profit drops. Now you might be wondering what's causing these profit drops. There are a few key factors at play here. Firstly, the interest in mergers, acquisitions, and initial public offerings has decreased. This has had a direct impact on the bank's investment banking activity. Secondly, the banks have had to set aside more reserves in anticipation of more bad loans. But it's not all gloom and doom. Rising interest rates have helped boost net interest income for JP Morgan and Bank of America. However, these rising rates have also dented their mortgage and auto lending businesses. Meanwhile, across the pond in Europe, Deutsche Bank reported a 3% year-on-year increase in revenues in the third quarter, despite experiencing declines in the investment bank and asset management segments. However, expenses outpaced revenues, growing by 4% and resulting in a return on tangible equity of 7.3%. In the grand scheme of things, these numbers tell us that the banking sector is facing a different outlook for the year 2023 compared to the previous year. And this, dear listener, signals a need for strategic adjustments in the financial world. The banking sector's performance is a crucial indicator of the health of the global economy. How does this affect your investment strategy? Are you aware that the electric vehicle market is experiencing significant changes that could affect your investments? The third quarter earnings of electric vehicle startups, Rivian, Lucid, and Canoo, have painted a picture of a sector that's revving up, but not without its speed bumps. Rivian, for instance, produced over 7,000 vehicles and delivered around 6,500 in the quarter. But the gap between production and deliveries widened due to setbacks in ramping up a second shift and aligning production and delivery logistics. Despite these hiccups, Rivian remains hopeful of closing this gap early next year. Then there's Lucid, which produced over 2,000 cars and delivered almost 1,500. They're inching closer to their target of producing between 6,000 and 7,000 vehicles. With 34,000 reservations and nearly $4 billion in cash, Lucid is gearing up to make a significant impact in the EV market. And let's not forget Canoo, who has yet to produce any vehicles but announced plans to start production mid-November. With a new plant in Oklahoma set for production in the second half of next year and agreements for over 12,000 EVs, Canoo is certainly a dark horse to watch. These startups are still struggling to meet delivery backlogs despite increasing production. But their ambitious plans and the evident demand for electric vehicles signal a promising future. The future of transportation is electric, but the path to it is fraught with challenges. How are these developments shaping your investment decisions? Investing in this ever-changing financial world demands constant vigilance and strategic decisions. As we've seen, the banking sector is experiencing a dynamic shift, with Deutsche Bank's recent performance and strategic plans playing a significant role. Meanwhile, the electric vehicle market continues to evolve, with companies like Rivian, Lucid, and Canoo navigating through their unique challenges. In this whirlwind of financial developments, it's crucial to stay informed, to understand the impacts, and to make strategic investment decisions accordingly. Don't miss out on the latest financial news and insights. Subscribe now for more updates and keep your investments on the right track.